I think we can go ahead and kick off and folks join. That's great. Welcome to the webinar regarding preparing for Wiz's IPO, potential IPO. I'm John. On the panel with me, I have Chris and Brett and another John, John K. Chris and Brett are both advisors here at Secfi Wealth. They're both, specialists in equity compensation, and they're going to be doing a lot of the discussion today regarding, taxation and some of the intricacies behind exercising options and how to make those decisions and how it fits in with the rest of your financial life. For my part, I'm the head of portfolio management here at Secfi Wealth. I've worked on the sell side, so investment banks. I've worked on the buy side, mutual fund firms, investment firms. And I'm going to talk a little bit about the IPO process and what to expect as an employee going through an IPO. So hopefully this is really relevant and interesting to you all. The fourth person who's not on the page here is John Klingler. He is part of SecFi's financing team. So the part of SecFi that finances option exercises. So if folks have questions regarding, financing for options, he's here to answer any of those questions. As we go through the discussion today, feel free to chime in with questions, and we'll do our best to address them all. We did get a few prior to the webinar starting, and we're going to attempt to address those throughout the discussion. So in any case, let's go ahead and get started. There's some disclaimers. The main gist of the disclaimer is this is educational. You should consult an advisor to understand your particular situation, as a lot of this stuff is very personal and dependent on what else is going on in your life. For our part at SecFi, we have some offerings that you may want to take advantage of. One is DIY tools. So on our website, we've got some tools that can help you evaluate your options and understand a little bit better how much it might cost you in terms of taxes and exercise costs to exercise those options. And would really encourage you to make use of those. We also have full service financial advice and wealth management. That's what Chris, Brett, and I do here at SecFi. And then we offer financing as well for select companies that we've underwritten and approved. There may be a way to get a loan, essentially, to exercise your options. So that's what SecFi does as a business. Different levels of engagement, obviously. DIY is DIY. Financial advice and wealth management, very hands-on with a partner. And financing is transactional, and can help you take advantage of some things that we're going to learn about today regarding stock option exercises. So that's for our part at SecFi. So let's take a look at the IPO timeline. Where are you in this timeline? Well, you're in the rumors and speculation part of this timeline. This all kind of kicked off in earnest when Google made the offer to purchase Wiz for $23 billion. And for whatever reason, that deal did not proceed. And it was indicated pretty strongly that rather than pursue an acquisition, Wiz is on the path for an IPO. So that's what we're here to talk about today. The rumor and speculation stuff can last for a long time. So I wrote months here on the timeline. It could be, next year. It could be in 2 years. But from the way options work and the way taxation works, this is a good thing. You have some time on your side. So right now is the right time to start thinking about it. When it really becomes serious is when the company files the S1. The S1 is otherwise known as the registration statement. And it's basically a document that tells the SEC, hey, we want to go public. Here's all the stuff that you need in order for us to do so. After the S1 has been filed, the company typically embarks on what's called a roadshow. And that is essentially the company and its investment bankers pitching the story to potential investors on the buy side. So big pools of capital all over the world may be interested in buying Wiz stock at the initial offering price. And the roadshow is where the bankers and management of Wiz would sort of feel out what the demand is and try to tell the story and get a sense of how strong the reception might be. A few weeks after that is typically when the initial offering actually occurs. If you pay attention to this kind of stuff, you usually don't know what the IPO price is going to be until right before the IPO. Like I'm talking a day, maybe, before the IPO actually occurs is when they finalize the initial offering price. Once that initial offering occurs, which is the new investors buying shares that now can be publicly traded, usually it's a few hours until the stock is actually listed and trading on the stock exchange. And then the next significant event is the lockup expiration. So most of the time, employees or insiders of a company that has IPO'd, they are subject to a lockup, meaning they can't sell right after the IPO occurs. They have to wait some period of time until they're eligible to sell, and their shares are restricted until that period of time. The typical lockup is 180 days, but it's really up to the company and the bankers to determine what that lockup is and if there are any kind of provisions in it. Sometimes companies will say like, hey, if our stock trades above this number for 2 weeks, then the lockup expires. There are multiple different ways that they can structure it. And it's something that you'll want to pay attention to as the process progresses, so you know exactly when you are eligible to sell. And that can have a real impact on the taxation. So all this stuff is important here. Okay, so let's get into equity. It's pretty complex. There's a lot of terminology, a lot of it depends, a lot of what have yous. So if it feels complex, it's because it is. So if you're feeling overwhelmed, you're probably not alone. It can be pretty daunting. So start with that in mind as we go through some of this stuff. And today, we want to help you understand some things about equity, so you can figure out how to handle it. And we start with education. That's where we're at today. Hopefully, this education encourages you to take step 2 and create a plan, because everything, all the good information in the world is worthless if you don't act on it. So hopefully today we can educate you, and that will be beneficial and will inspire you to set up a plan for what you want to do for your stock. Now, with that, we're going to get into the agenda to talk details about stock options and RSUs. And for that part of the conversation, I'm going to first kick it over to Chris Arnold, one of our lead financial advisors, and he's going to start by talking us through the different forms of equity compensation. Go ahead, Chris.
Thanks, John. So to kick things off, so there are 3 main forms of equity compensation. The 2 on the left-hand side are the 2 forms of stock options. So you'll see there are incentive stock options and also non-qualified stock options. And then for a later stage company, as the company grows and the valuation goes up, they may begin to start issuing what's known as a double trigger RSU, or a restricted stock unit. And I'm going to start by unpacking your stock options. So at its core, a stock option gives you the right to purchase shares in your company in Wiz at a fixed price. And that fixed price is your exercise price or also your strike price. Those are the same terms. And those are going to be consistent throughout your tenure at Wiz, no matter what the company's valuation does in the future. Now, the thing to be mindful of is as the company's valuation continues to go up, when a company is private, that valuation is known as the 409A valuation, or fair market value. And as that increases, the tax exposure that you would have to exercise an option gets higher. So in my conversations with some Wiz folks, a lot of them have incentive stock options or ISOs. And just by the name incentive, that means that there is some favorable tax treatment if you meet certain criteria. And the key criteria here is that you exercise the option and you hold shares for at least 1 year from the date of exercise before you sell, and also 2 years from the date that the option was granted to you to be able to get some favorable tax treatment on the sale. Non-qualified stock options, it's going to be subject to ordinary income tax on that spread when you exercise. And then RSUs, you don't actually have to buy these shares. They just are vesting. And then there's going to be a liquidity event is that second trigger in addition to a time-based vesting schedule of when you would actually realize the value for your Wiz equity. And that second trigger is often going to be in an IPO or an acquisition event. So to get into the taxable events for equity, you'll notice that with stock options, so vesting your options is not a taxable event. So a common vesting schedule when you join the company, you may be awarded 10,000 stock options that are going to be vesting over a 4-year period with a 1-year cliff. So I'll start by the 1-year cliff. That just means that you have to stay at the company through your 1-year anniversary to be eligible to buy a percentage of the shares. And if you stay on a 4-year vesting schedule, 25% of your original grant, you'd be eligible to exercise upon being vested. So the two taxable events, potential taxable events with options are 1, the exercise event, and then 2, the sale event. And so as I mentioned previously, when you exercise an ISO, the type of tax that you may incur is known as alternative minimum tax or AMT. Now, the nice thing about AMT is you can exercise a portion of your ISOs each calendar year and not have to worry about any kind of tax. As that valuation goes up, the number of ISOs you can exercise in a calendar year is going to go down. So one way to think about this is to exercise over a multi-year period can help to reduce your tax exposure on exercise and also start the clock on the holding period for these shares, which is going to help lower your taxes upon an eventual liquidity event. If you have NSOs or non-qualified stock options, if there is any appreciation between Wiz's fair market value or 498 valuation in your strike price, that spread is going to be taxed as income. So it's just going to be taxed the same way as your salary or any kind of commissions would be. And then on the sales side, again, with ISOs, if you meet certain criteria, so that's hold the shares for at least 1 year post-exercise and 2 years post-grant, it's going to be considered a qualifying disposition. And that qualifying event just means that the sale price minus your strike price is going to be subject to a lower tax rate than income taxes. And that's known as the long-term capital gains rate. So the name of the game with options is if you're optimistic on the company, you want as much upside for the company stock to be taxed at the lowest possible rate. And the way that you do that or you position yourself to achieve that is by exercising options ahead of a liquidity event. And then just to touch on RSUs. So as I mentioned, you don't have to purchase these and they're just going to be vesting until there is that second trigger, a liquidity event. And upon that trigger event, that is going to be the number of units that have been vested times the stock price at the time is going to be realized as income and subject to income tax on that date. And when you sell, if there's any further appreciation from the price that it vested at, that is going to be a capital gains tax.
And I'll just chime in. And if there is depreciation after your stock vests, then that's a capital loss from where you vested the shares. So it goes both ways on all of these things.
Yeah, it's a good call out, John. Thank you. Okay, so we've talked about a couple different taxable events, and I've also mentioned that there are multiple forms of tax. So there's income tax, and this is the type of tax that you pay on your typical salary. There's AMT or alternative minimum tax. And this is a very nuanced and a specialized type of tax that startup employees are some of the few that may ever run into this. On a federal level, that the AMT rate is 26% or 28%. There are also some states that do impose a state level alternative minimum tax. California is one of the few states that does. I will say most states do not have that. So anyways, if you're thinking of exercising incentive stock options, just check out the state rules or reach out to an advisor just so that you're not surprised with any AMT exposure on a federal or a state level. But you'll notice that income tax and then short-term capital gains, so those rates are the same, and they're also the highest possible type of tax. And so the nice thing about alternative minimum tax is it is higher than the long-term capital gains tax. But what we'll talk about today is if you exercise and you do happen to incur alternative minimum tax, you can think of that as a prepayment of tax. And when I say prepayment, that just means that it can help to offset the long-term capital gains tax that you would have upon a sale event. And when I say offset, you receive that, and that actually happens through what's called a tax credit. And a tax credit is simply just a dollar for dollar offset of what your tax liability is. So if you have a $50,000 tax liability and you have a $10,000 credit, you net only pay $40,000. So anyways, you can think of it as, if you're optimistic and you think the valuation is going to be going up, it could make sense to take on a little bit of AMT exposure, knowing that you have that in your back pocket, and that could help you to set up to have more of that upside and growth for Wiz taxed at a lower rate upon the IPO price.
Chris, we did get a question come through about an ISO exercise. If the IPO happens when the exercise shares are not qualified yet. So it sounds like what they're saying is like, if you exercise and then the IPO happens before you've held them for at least a year, what's that situation like, and how does it differ from a qualifying ISO disposition or share disposition from an ISO exercise, to be precise?
Yeah, good question. So the IPO event is not a taxable event for stock option holders or for shareholders. For RSU, individuals that have restricted stock units, that could be a taxable event. But the key taxable events for stock option holders are going to be the exercise date and the sale date. So if you've exercised, let's say you exercise 6 months ahead of the IPO, so after the S1 has been filed and there's a pretty good sign that Wiz is indeed going to progress to become a publicly traded company, then on the IPO date, you would have held the shares for 6 months. You would still need to hold or maintain possession of the shares for at least another 6 months to reach that long-term capital gain status. So I think that's something, and John mentioned, in the timeline, there's typically going to be a lockup period, and that means that you're restricted from selling the shares. So that scenario that I gave could actually be quite favorable, is you're not able to sell the shares for 6 months, and then by the end of the lockup, you are at the long-term capital gains period. But to answer that question directly, the IPO event is not a taxable event. It's just on the exercise event and then the sale event for option and shareholders.
Yeah, they had a little clarifying way of putting it, and basically they're asking like, what is the actual benefit of exercising pre-IPO? And what they said was because it starts the clock on long-term capital gains, and that is absolutely correct. There are other potential benefits, which I typed out, but I'll say it as well. The earlier you exercise, assuming that the valuation of the company keeps increasing, the less AMT you might have to pay. So, that AMT bill can be pretty large if you have very low strike price options and the company has done well, therefore the fair market value is appreciated. And so, it is a trade-off, right? Like the earlier you exercise, the less certain you are about the prospects of the company and the prospects of a liquidity event. But it might also save you some money on the alternative minimum tax burden.
Yeah. And I think to also just to share with folks, so if you don't meet the criteria with ISOs to meet a qualifying disposition, the other is a disqualifying disposition. And that simply means that the type of tax you would incur on the growth of the shares when you sell is either going to be income or short-term capital gains. So it's going to be a higher rate, as you'll see. So potentially to the tune of paying 37%. And then if you happen to live in California, an additional 13%. So you're paying over half of your money, your proceeds are going to be going to taxes, as opposed to if you meet that criteria, you set yourself up for the long-term holding. Now on that upside, you could potentially lessen your tax burden by 17% by having the long-term capital gains as opposed to the income or the short-term capital gains. So I think that's the big thing that we try to get across is, yes, there are risks to exercising options, and yes, there could be a pretty hefty AMT bill. But I think if you take a multi-year approach to this and keep the AMT within reason, then you can get, you can position yourself to, instead of paying 37% on more of that upside, you could be potentially paying as low as 20% or lower than 20, but it's the high end would be 20% for the long-term capital gain. So touching on here, I mentioned the term 409A valuation. And for some folks, especially if Wiz is your first startup company, you may have never heard of this term. And so another name for this is the fair market value. But for privately held companies, a 409A is just an external or a third party valuation for what is the common stock worth. And you, as an employee that are granted stock options, you have common shares or the ability to exercise the option and obtain common shares. That is different than preferred shares of what VCs or investors are paying for Wiz. So when you see a headline of, Wiz raised $1 billion at a $12 billion valuation, that is the investors are paying for convertible preferred stock. And the hope is that if all goes well and the company continues to appreciate, then on the IPO, those VCs are going to convert their preferred shares into common shares, and it's just going to be one price, the fair market value or the listing price of the IPO. But because you have common stock that does not have the same preferences that the investors have, so in a bad scenario, the investors get paid back first before any of the employees would receive profit. But also because the company is private and it is illiquid, you can't just log into your E-Trade or your Fidelity account and sell Wiz shares tomorrow. So there's some discounts to that internal valuation, and that discount to the internal valuation can actually be quite favorable for option holders that are looking to exercise. One of the reasons is because the spread or the bargain element of the option between the 409A valuation and your strike price is going to be one is the biggest driving factor of what taxes you owe upon an exercise event. And again, the larger that spread gets, the higher your tax exposure is. And so if upon an IPO, that price, the preferred price and the fair market value converge, it's going to be a much higher tax exposure to exercise. So that's another reason why exercising, pre-IPO, while that internal valuation is still lower, could be attractive to lighten the tax burden. So anyways, just wanted to kind of mention, what is that 409A valuation? Fair market value is another term that you might see in the platform where your equity is held. And then, lastly, before we get into more on kind of structuring, your overall financial situation, this is a sample or kind of some of the things that we as advisors think about when helping to craft an exercise plan for the individuals who work with. So, we've talked a lot about the tax implications and the tax potential benefits of exercising ahead of an IPO. But the way I view it is your Wiz stock options are just one piece of your overall financial life. You probably have other assets. You have bank accounts or maybe a retirement account or a brokerage account. Maybe you have children and you set up an education account for them. And you may also have other financial priorities. A lot of folks that we work with are in a life stage where they're trying to buy a house or they're getting married or they're starting a family. And all those things have financial implications with those. And so what we try to do is, first educate so that you can make an informed decision. And then truly, really listen to kind of where you're at, figure out a way that, does it make sense to exercise these options? And if so, where should the money come from? Before we dive into, a deep tax analysis, we also like to just kind of get your stance of, how long do you think you're going to stay at Wiz? How many additional options is it likely you're going to invest? What's your outlook on the company? Again, what is, how concentrated are you, and or how much does Wiz stock make up of your overall net worth? And the higher that is, the more risky it is. Because if, Wiz were to not have a liquidity event, we wouldn't want this to set you back from some of the other, financial goals that you have in your life. So we take a look at a lot of different factors and really just try to understand your situation today, what you're hoping to do with your life going forward, both from a family life, but also a career perspective, and then really to kind of craft an informed strategy that takes into account taxes, but also, where the funding should be coming from. So last slide for me, and then I'll turn back over to John, is, tangibly, like, how do you actually go about exercising your option? So exercising your option just means buying shares at that strike price. So you pay that money over to your company in return for a stock certificate, or just receiving, that you are a shareholder in your company. So the exercise price times the number of stock options, that goes over to Wiz. There may also be taxes if you have NSOs or non-qualified stock options. Some of those taxes will be due on the exercise event. If you have ISOs, you may owe tax, but they're not going to require you to pay that tax up front. You're actually on your own. You need to then potentially make estimated payments. And that's something that we can talk about, what that actually means. But they may not take it from you or may not say you owe it, but that doesn't mean that it's not there. So you may have to set aside some additional money to cover some taxes. The stock certificate will be issued, usually, within a couple of days, maybe a few weeks after you initiated the exercise. And then you then can spread the tax payment over the course of, multiple quarters, or even the following tax year, just to make sure that there's no tax penalties and that you have paid up the full amount of either income tax or alternative minimum tax that was due from that exercise event.
Awesome. Thanks, Chris. And please keep the questions coming. Now, I'm going to talk a little bit about IPO stuff again. So, of course, all of this is dependent on a successful exit for Wiz, right? So you may be thinking, well, is Wiz going to IPO and win? Those are, questions that we don't know the answer to. Like, I don't have a crystal ball, but I can give you some context about when companies tend to IPO. So what you're seeing on the page right now is a graphic of the IPO capital raised in the blue bars and the NASDAQ in the black line. And the correlation is IPOs tend to happen in strong markets. So during during a rising market, you get a lot more IPOs than after a market that has fallen or during a falling market. So if the stark example is just a couple years ago, 2021, everyone probably remembers those heady days when everyone was seemingly trading on their phone and markets were roaring. Guess what? A lot of companies went public that year because investors were demanding more investment opportunities, and the managers and investors in those IPO companies saw that they could get a pretty good price for their shares. So they went out and raised capital and IPO'd. And then the markets turned. And 2022, we had a dearth of IPOs, the worst IPO environment, when measured by capital raised in a long, long time. 2023 was a bit better, and 2024, which is not on the chart yet because it's not over yet, has been a little bit better still. And the markets have been quite strong lately. So if it holds up, I would not be surprised to see IPOs coming back in significant size in the near future. Things can change though, and I just want you to be aware of like what type of environment companies tend to go public in. Brett, did you have something you wanted to add? Okay.
Oh, good.
Saw you unmuted. You're good. Okay, so given that, a decent amount of your wealth and financial independence might be riding on a kind of binary outcome of a successful Wiz IPO, we wanted to talk a little bit about like risk management and how do you ensure that you're, taking the right risks with your wealth. And the way we think about it is what Chris kind of alluded to earlier, which is that we want to think about your entire portfolio. And we want to be even broader than that, and consider also your human capital. So your profession and what industry you work in, and how that might be correlated with your future wealth. So on the left-hand side, I have some cherry-picked headlines of stuff that has been bad for companies. Basically, all I'm trying to say is, like, when you're significantly concentrated in a single stock, you're exposed to idiosyncratic risks. And that is, a real risk that is very difficult to measure, but can be devastating. What we do for our clients who become wealth clients at SecFi is we try to build a portfolio with the rest of the client's assets that is complementary to both their financial capital, like in your case, your Wiz equity, and your human capital, which is, might be related to the tech sector or the VC startup world. And we try to build those portfolios while still getting market returns or better. So that's our goal. So we're trying to diversify you, lower your volatility, and maintain or increase expected returns on the portfolio. And we do that by, like I said, building a complementary portfolio. So not to scare you too much, but on the right hand side, I have a single stock example of an idiosyncratic risk. And I think everyone on this call will remember this, but not too long ago, CrowdStrike was in the headlines for a big outage, and their stock cratered on the news. It fell by 40-ish%. Um, all it takes is, one event like that, one crazy, outlandish thing that you didn't think was possible to happen to really affect your finances if you're concentrated. So how do you protect yourself against this? First, you have to identify what risks you're exposed to. That involves understanding your portfolio, both financial and human capital. And then it also involves building a complementary portfolio. And when I say complementary, that often means globally diverse, which means, no reliance on one stock, industry, or theme. And if we do that right, we can still have a great investment experience and manage risk at the same time. So that's our goal when we are investing on behalf of our clients. And if you are someone who is heavily invested in the same sector that you work in, because it's what you might be exposed to a lot more risk than you should be taking, frankly. So think about that as you're preparing for your IPO and committing capital to option exercises, because you may be concentrating your portfolio even more as you do so.
Thanks, John. So we actually did get a couple questions here regarding how do we make equity decisions? How much equity should I buy in those kind of situations? While the question did iterate that they understand that it's very complex, we might be able to walk through some like more simplistic ways, but we wanted to show you guys the ways we think through these with clients, the way we think through these when we take calls with prospects. And the first thing really starts with something that Chris kind of drove home already, which is, have you taken time to determine your why? You might be sitting here going, what does that mean? That's a super broad term. To us, determining your why is really understanding what matters to you. Okay. It is going to be the lens through which you make financial decisions. Okay. So for some people, that could be generosity is high on their chart. So they like charitable giving or giving their time. They want to be able to support family members. Maybe it's taking trips with people or taking parents on trips, enjoying life today. Okay. Not just in the future, but today. So why we really like to have people spend time determining their why is as we get closer to really any sort of liquidity event, especially an IPO, the events become extremely exciting, right? Emotions can get the best of you. The Slack channels really start to blow up. The what if scenarios that start floating around your brain really increase. Okay, so knowing your why ahead of time is going to help guide the path to the impact that the decisions you have um, today that are being made today will have on your future. So a couple things that we really like to say around determining your why is we really want people to be enjoying their best life today and in the future. So what are the things that are bringing you joy, right? So for some people that's sabbatical, for others it's taking trips. The goal is that we want you to be able to enjoy that today while you are buying your equity, okay? And also be able to enjoy that when hopefully there is the liquidity event. Okay. It's also going to help your investment strategy. So John kind of alluded to the diversification key. John, if you can go to the next slide. When we analyze people's financial life plans, a lot of the things we are looking at are how do we build in complex equity decisions around your greater financial picture? Okay. And Chris alluded to this too. Having a very high concentration in a strong private company is not abnormal. Okay, so we don't want you to be scared off by having that type of concentration because it's incredibly usual for most of the people that we are working with. But we do have to take into account what is happening when we do take on that concentration. Okay, so what are we deferring down the road? Could it be finding scenarios in which many of our clients are, they want to buy a house at the same time as they are looking to purchase equity, right? So how do you evaluate those decisions? Determining your why is going to help really put a lot of that into perspective. Okay. And it's really going to help prioritize how we can accomplish maybe both things, right? Like Chris mentioned, there is some opportunity in AMT land where you would not have to pay a tax bill, right? So maybe it's a year of being less aggressive so you could buy a home versus a year where you're very aggressive in buying your equity and you push off a home, right? Each situation and each choice is highly individualized. Okay. And it takes a lot of deep thinking to figure that all out. I'd also add that when you understand what your goals are and what you're trying to achieve, it is going to bring discipline to not just your purchase strategy of your equity, but when the IPO does come, it's going to be your sales strategy, right? It is going to be, I know what I'm looking at. Thank you, John, for swapping slides. This is a great visual here, and this is what we use with a lot of our clients. What we want to be able to see are what are the things that are important? How much money do I need out of those situations? Okay. And that is going to give you this outcome, okay, of your plan where we would say at specific share prices, this is what we're looking at as proceeds, and these can fund these type of events. Okay. It's important that people understand as well, you don't have to have your life figured out today. Okay. It is an ever moving goalpost. Okay. Sometimes those goals seem a lot further and that field goal seems way too deep. Other times it gets a lot closer. Okay. So those goalposts are always going to be moving, which is why we're always updating sales plans, purchase plans, and taking advantage of opportunities. One thing I did want to point out that was brought up earlier. It was actually brought up in one of the questions, so I guess I will address it around how I think the question was somewhere along the lines of how should I consider making a decision around my equity? There are the determining factors of like your why, which are internal factors to yourself. Okay. There are the factors of what can your financial life support? Okay. Like, can I afford it? Do I have to go utilize maybe like a Secfi financing option, right? Those things need to be weighed, as well as there are things that are outside of your control. One of the major things that is looming is a potential tax law change. Okay. At its highest level right now, tax laws are very kind when it comes to people that are exercising incentive stock options. And what I mean by that, without getting too complex, is that there are things called exemptions, okay, that exist in the tax code. And right now, you have a very large exemption for the alternative minimum tax which is based on your filing status. And it has created a large gap, okay, between your taxable income and between AMT tax, which means that bargain element that Chris talked about when you are exercising incentive stock options, you are going to be able to push more of that bargain element into the alternative minimum tax before you would pay the alternative minimum tax. Something just to be cognizant of is that if the Tax Cut and Job Act does sunset and it does revert, tax law reverts back to what it was prior, that exemption will be whittled down greatly, which means that it will be a less friendly environment to purchase your incentive stock options without getting into an AMT situation. So again, that's not advice to go out and get crazy or anything like that, but it is the thought that you should be thinking about these things because there are things that are outside of your control. Okay. And tax law is one of them. And we always say here that we never want to waste a tax year. I don't know if Chris said that earlier, but we never want to waste a tax year. And there might be some opportunities here if you are bullish on the company to potentially consider being more aggressive than normal.
Just one thing on a sales plan. Oh, go ahead, Chris. Sorry.
I was going to say, just to elaborate on when, Brett says never waste a tax year. So you only are responsible for paying alternative minimum tax if it is higher than your income tax for the year. And so when Brett was talking about exemptions, that is why most individuals have never been responsible for paying AMT before, is because that exemption brings your AMT income to be below your regular taxable income. And so when we say never let a tax year go to waste, is you can think of that you're trying to get those two to be in line or to break even with one another so that your tax withholding on your pay stub has largely already covered all of your liability and there's no further out-of-pocket tax that you would owe in the form of AMT for exercising incentive stock options. So just wanted to kind of clarify when we say taking advantage of never letting a tax year go to waste.
Yeah, thanks, Chris.
Yeah, great point, Chris. I just wanted to make a point on sales plans. Like this is illustrative, obviously. It's really going to depend on what you want to accomplish. What we're trying to say, though, is have a use for the funds and know what you want to do with it. Because one thing we've seen as we've taken other clients through IPOs is if they don't have a plan, they tend not to sell. They tend to sit on it and wait and kick the can because they're like, well, every dollar it goes up, I make another 100 grand. So what if it goes up to 40 from 35? Then I made another $500,000. And that sort of way of thinking starts to get really seductive, and they can never, can get themselves to pull the trigger and diversify their investments. Sometimes that works out, but the fact of the matter is, like, the majority of stocks underperform. And a lot of IPOs end up below their IPO price. So it's always risk and reward trade-offs to make. But that's the situation that we want to avoid. We want you to have a plan, because if you have a plan, you're much more likely to actually follow through on these good financial decisions than if you don't and you sort of leave it up to, I'll see how I'm feeling on the day.
I think the last point I will add is, if you're able to secure, some of the wealth from the Wiz stock, a lot of the folks that we work with are still, in the pretty early, stages of their life and their career. Most of the folks we work with are in their, early to mid 30s. Some of them, have just touched 40. So they still have, a lot of, life ahead of them. And if you're able to, realize this, because there's a lot of startups that never, reach, an IPO, it allows you a lot of flexibility and potentially to take, some bets on yourself, whether that is, a business venture of your own, if that's moving, to an earlier stage company and getting a bigger equity stake, and being able to be a little more aggressive with exercise decisions on that. There's some, tax benefits with, it's called qualified small business stock, that we've also helped folks through. So I think that's the other angle that we like to take is, if you're fortunate enough to be at a company that does have a liquidity event and you can realize some of this, it can just open, a lot more opportunities for you to take risk or to secure yourself in your financial future. So anyways, something just to kind of food for thought to leave you all with.
Yeah, it's the way I think about it is kind of like what they say at the beginning of the airplane when you're taking off on a flight. It's like make sure you secure your own face mask before helping others or whatever. Like get your financial life situated and secure financial independence before you start swinging for the fences and taking big risks with the residual. That's kind of the philosophy that we have here. We want to get people to be financially independent and and at that point, there's a lot of doors that open in terms of opportunities to take different types of risks and potentially benefit. So um, with that, we'd love to answer any more questions if you guys have any. I don't see any open ones at the moment, but feel free to type them on in. Otherwise, we'll keep it open for a minute here. But I encourage everyone to check out secfi.com, sign in, use the tools. We've got a bunch of content up there that can explain some of these concepts in more detail. And you can also book an introduction call with us if you'd like to talk about your own situation, see if it's a good potential fit to work together long term. There's no fee or obligation with any of those intro calls, so feel free if you just want to have a chat. And with that, I don't see any other further questions out there, so we can go ahead and close up about 10 minutes early.